right, welcome back to Robinhood Stock Market Watchlist Group. My name is Carlos, one of the administrators of the group, and today is January 20th, or Sunday the 23rd of 2022. We always like to go over the advanced basics, and but we're going to cut it a little short. That way we kind of go over certain particular things every weekend, and then we'll start really planning ahead, looking into this week. So one of the most important things that an investor and a trader must master is something called moving averages. So that's the educational part that we're going to focus on today, and then we'll move on to planning ahead, looking at this week and what it's going to look like. So, but moving averages is the foundation of every strategy, no matter if you're just a long-term investor, short-term, or if you're just a swing trader or a day trader. We all use moving averages as part of our foundation of our system. And so if it's something that you haven't yet utilized, it's really, really important that you do. And so I do have a few videos that'll kind of explain what moving averages are and how it can benefit you tremendously. And we'll pull up an application on that way we can learn how to customize it for your style in trading or investing. So give me a moment while I pull that up here for you.
The moving average is one of the most commonly used technical indicators. If you've spent even a little time looking at price charts, you will have noticed that most often the price of an instrument will move up and down. In fast-moving markets, you may find that the price may be surging up only to plummet moments later before surging up again, increasing the potential for false signals. The moving average can help filter out the noise from random price movements and smooth it out in order to see the average value. Moving averages are used to identify trends and confirm reversals. When the price is above the moving average line, we consider the instrument to be in an uptrend. Conversely, if the price is below the moving average line, we consider it to be in a downtrend. The breaking of the moving average line usually implies a trend reversal. Moving averages are also used to identify areas of support and resistance. Many traders will consider the moving average line as a support and resistance level indicator and base trades on it. So traders will check to see whether the price is going towards the moving average and see whether it will bounce back from it or break it, as with regular support and resistance level. Oftentimes, the price of an instrument will find support at the moving average line when the trend is up, and will find resistance at the moving average line when the trend is down. So moving averages will tell you whether an instrument is trending up, down, or if it's ranging. It can tell you if a trend is still in motion and whether it is reversing or losing momentum. Have in mind that a moving average is based on past prices and is known as a lagging indicator. Therefore, it will not warn you in advance, but it will confirm when a trend change has taken place. At the most basic level, when the price crosses up and over the moving average, traders take this as a signal to buy. When it crosses down under the moving average line, they consider it a signal to sell. Let's take a look at the types of moving averages. There are three main types: simple, weighted, and exponential. We will discuss the simple moving average, or SMA, first and show you how it's calculated so that you can adjust it according to the given market circumstance. So if you wanted to plot a 10-day simple moving average, you would add the closing prices of the last 10 days and divide by 10. This calculation gives equal weight to each day. It's called a moving average as the oldest price is dropped each time a new period becomes available, in this way ensuring that the average is based only on the last X number of periods, in our example for the last 10 days. Have in mind that the longer the simple moving average period, the more it lags and the slower it is to react to the most recent price movement. And this brings us to its downside. As equal weight is given to all periods considered in the calculation, the simple moving average is slower to respond to rapid price changes that might prove to be important. So how can you counter this? With another type of moving average, either a weighted or an exponential moving average. The weighted and exponential moving averages are calculated differently from one another, but both types give more weight to recent periods and thus more emphasis on what traders are doing at the moment. So as a result, weighted and exponential moving averages respond faster to price action by distributing more weight to recent periods and less to older periods. They reflect a quicker shift in sentiment, which can be due to changes in supply and demand or important news events that impact the traded instrument. To illustrate what we mean, if you were to plot an exponential moving average and a simple moving average on a chart, you will see that the exponential moving average is closer to the current price than the simple moving average. Apart from the type of moving average, you also have to decide on the time period. This will largely depend on the type of trend you are analyzing. Here are some guidelines for commonly used time periods: 10 to 20 for short-term trends, 50 for mid-term, and 200 for long-term trends are typically used. When and how should you use moving averages? Deciding which moving average to use and the time period will depend largely on your objective. Use exponential moving averages for shorter time frames, or if you're analyzing a fast-moving market, as you'd have more emphasis on the latest prices. Use simple moving averages if you are planning on holding a position for a longer period of time, as the exponential moving average might be too sensitive and give false signals. You should also use simple moving averages if you'd just like to filter out the noise from random price fluctuations to determine the overall market direction. Thank you for watching this tutorial on moving averages.
All right, there's a few things in the video that we need to kind of dissect a little bit. Let's start from the beginning here. You have your normal price line, and then you have your certain points. But the main thing is the moving average, just like I said, is a lagging indicator, lagging price based on time, that when the price line, no matter what, whether you use lines or candles or whatever, when it goes down through the moving average line, indicates that it's downtrending. And then what comes up, same thing. So that way you can kind of see this is the uptrend, and then the other one is your downtrend. Right there. So after a while, when you trade using moving averages, you start to mentally visualize this just by second nature. You just do it, but you have to know what these trending zones look like, and you just have to imagine it once you start seeing it. And the main points are right here, are the crossover points. Those are the indications letting you know when to buy or sell, especially if you're into options, because a normal sell signal, when the price line goes down, you can buy a put or buy puts. And when you're betting against the stock as it's downtrending, as the stock price goes down, your account is going up tremendously. So there's just a lot of great tools that we'll be able to continue to talk about here, because right now our stock market is going through a correction. The whole entire system, I think, is down almost 10%, and that's where you start considering things in a correction, especially in a short period of time. So we need to be able to think smart, think logically. We got to keep our emotions out. We got to know what is going on and how to react to it. And so we'll continue on here. No matter what type of graph you're looking at, whether it's a 1-minute chart, 5-minute, or a daily graph, it just depends on your style and everything. And so, as the price comes down, it starts forming a little bottom area, and this is kind of like your resistance area, and then you got your support area, which is on the high part, which is kind of the area that we've been seeing a lot of right now. So we've basically left the support area, and we're coming down, forming a resistance. And that's normal for this time of year. We are in the most bearish part of the year, which is the winter season or the first quarter. And typically the reason why the first quarter is so bearish anyways is because they're always going over yearly stuff, whether it's yearly earnings or yearly economic reports, and there's always things that are mentioned that spook investors or investors in Wall Street, don't really want to hear, and that's normal. And a lot of times the politicians and the government or other companies will just pour fuel on the fire to make it worse, or hedge fund companies to that way they can short it. They can bet against stocks, and stocks go down. So they're basically pouring fuel on the fire, and then doing the reverse. When the first quarter is about to end, and we're in the transition from going into the second quarter, which would be the springtime, which is the season of the transition of going from bearish characteristics to bullish characteristics. But it is highly important that you know what your buying and selling signals are. And we're going to talk more about that. We'll dive into Webull, because it is really important that you know how to communicate with this system. It is your guide. It's like your assistant telling you, hey, it's time to buy or it's time to sell. You just have to be able to know how to coordinate some of these things. So let's switch over to Webull here really quick. Now, Webull is a free application that I use. You can download it on their website. You don't even have to log into it to really use a majority of its features. But let's change something here. Let's go to one graph here. I'm not sure what I mean. Let's take a look at Apple, for example. So I'm going to switch over to the daily part. Now, the important thing is how to configure this for your style in trading or investing, because some of you guys are long-term investors, maybe short-term swing traders or day trading. So we're going to talk about all of them, starting with the more or less the long-term and short-term part, because if you're a short-term, long-term investor, you're going to want to mostly look at the daily charts. And it's also important, like the video had mentioned, is a couple different styles in your indicators, your moving averages. And the reason why there's different kinds is because some react quicker or more slower to the price movements. And so if you're a day trader or swing trader, you're going to want a moving average that's more reactive to the price changes. Versus a long-term investor or short-term investor, you're not going to want the moving averages to react as quick, because you don't want as many signals. You don't want a whole bunch of buying and selling signals. You just want more of a, just let me know if it's anything major or whatever. So the moving average indicator is right over here on the desktop application, but you'll be able to see it on the mobile application no matter what type of app that you're using. But you'll just have to click on it, and a little settings gearbox icon will appear. You'll have to click on that, and then your settings indicator menu appears, and then you'll see your main chart, which you can only select one, and then you have your MA, which is your most commonly used moving average. It doesn't react too quick, doesn't react too slow. It's just right in the middle. Where EMA is one of the most reactive moving averages to price changes. And so that's the one I use, because I'm more of the day trader and swing trader, so I need it to be reactive, so that way I can get in, I can get out and secure my profits and repeat the process over and over again. So with that being selected, we have our lengths. We have several different type. We can change them, but they primarily represent, as we're looking at a daily chart, each notch is 1 day. This would represent 5 trading days or 1 week. The next one would be 10 trading days or 2 weeks of a moving average. Then the next one would be 20 trading days or 4 weeks, or it would be a 1 month moving average. So then you have that. Over here you have a month and a half. Then over here you have a 3 month moving average. Then you have a 6 month moving average. So if you're a long-term investor, you're going to want probably these 3 bottom ones selected, or if you're more of a less or a short-term trader, you're going to probably want the 20, 30, and 60. utilizing 3 of them at a time, because it kind of gives you like a high risk indication, medium risk, and a low risk type indication, which we'll talk more about here in just a moment. Then we have our style, and this is where we can select which ones that you want, and you can change the color for your preference. And so just by leaving it with this setting here, we can kind of see Apple where its price line had just cut down through all 3 moving average lines. Now, while it's trending upwards, if it touches the first line, it'll be alarming, but it does indicate a certain percentage risk level, meaning once it touches the first line, there's a 75% chance it'll still bounce off of it and keep going up, but a 25% chance it'll go down. Once it touches the second line, then that means it's a 50-50 chance. 50% chance is it'll bounce up, or 50% chance it'll bounce down. If it touches the bottom line, that means there's a 75% chance it'll go down and 25% chance it'll go up. So the chances are more like the feeling's more alarming, because it's like, okay, you know, I really got to think about, you know, getting out, because the system is telling. And the MACD, which is down here, is the second most commonly used indicator that's paired along with a moving average. These two are the most highly commonly used by successful investors and traders, even for those that are millionaires or that are just figuring things out. This is the system that we need to use, and it's telling us prematurely that, you know, it's going to downtrend soon. You know, just watch out. And so you can see where basically these are 2 moving average lines without a price line on there, and then these colored bars are gap distance bars between the 2 moving average lines. So it being green is your uptrending zone, kind of speak, and then the red is kind of the downtrending part on the MACD. Doesn't mean it's downtrending yet on here, but it's just warning you, you know, proceed with caution, you know, just. And so watching the price line up here cut down through all 3 moving average lines right here when Apple was $174. So that was, you know, and then the last indication is when the moving average lines crosses over each other, and every one of them is trending down, is your indication that it's downtrending. It doesn't really indicate, you know, for how long or for how far it's going to go down until further notice. But we just have to watch it and just understand how this works. Now, and you can see a lot of crossovers. You can see a crossover here, you can see a crossover over here, and that's where, you know, short-term investors can get in, they can get out, and secure their process and repeat the you know, it over and over again. But you can see a crossover here, and there's another one here, another one there, here. But as a long-term investor, you might not want that. You know, that's too many. And so you can click your indicator settings and change those, and that way they're basically your 20, 30, or you can even go you know, even further out. So you don't see those crossovers anymore. In fact, there isn't one on here. Let's keep zooming out. So the last crossover was basically during the shutdown. That is when the price line cut through all 3 moving average lines. But and there was the crossover right in here, but it quickly bounced back up, kind of did the V-shaped recovery, just as I thought, but there's never been a crossover yet. So that's where you buy, and you hold until further notice, and and that's what you do as a long-term investor. And so that you don't see very many indications, but maybe once every year or every several years. And so, or maybe you need more indications, so that way you can go back to your settings, go to style, and then maybe do the 20, and then take the 120 out, and then you can see that there's now a little bit more crossover. So you'll kind of have to play with it, according to your style and level of trading or investing. Now I use lines over candles because candles can give you some information on volume, which we have the volume bars right here, so I need a clear picture of what I'm seeing. And so a lot of times you'll see people that'll use their line style. So you just right click in the graph, the little menu here appears. You can change a lot of your styles, and then but a lot of times you'll see people use candles, and trying to view the moving average lines can be a little fuzzy. Sometimes it can be a little frustrating. So I just need a clear picture of what's going on. But like I said, you can see the volume information right on the bottom. It's the same color and everything. So that way you can see whether it's a majority of buying activity or selling activity. But like I said, I need a clear picture of what's going on. That way I can get in and I can get out precisely when we need to. This is the trading system. Trust this system and let it guide you. Keep the emotions out. We have one more video that we'll watch, and I'll answer any questions that you guys may have. Give me a moment while I pull that up here for you.
We will now build on material covered in the first tutorial on moving averages, where we defined what a moving average is, the 3 types of moving averages, and how they are calculated. In this second tutorial, we will discuss how to use moving averages to identify the direction of a trend, how they can be used to enter and exit a trade, and finally, how to trade moving average crossovers. To determine the direction of a trend using a moving average, you must take into account the set time period. We touched on this briefly in the last video, where we showed you the most commonly used time periods when analyzing short-term, mid-term and long-term trends. But why is it important to be aware of the time period of the moving average? In this chart, when we place a 20-period simple moving average by clicking the indicator icon and setting the time period to 20, we can clearly see that it indicates an uptrend. Yet when we place a 60-period simple moving average in the same way, we see that it shows the price in a range with no clear upward or downward trend. The difference in the direction of the trend portrayed by the moving average is due to the time period. Shorter period moving averages are faster at generating signals, and changes in the price of the instrument will be reflected more quickly. The longer period moving average will react to price changes much more slowly, but will generally provide more reliable trading signals. As a trader, moving averages will help you decide which way to trade by looking at whether the price is above or below the moving average line. In this chart, the price is above the moving average line and acts as support. You could buy and enter a long position when the price pulls back to the moving average line. You could then place your stop loss underneath the moving average. Here we can see the opposite. The price is below the moving average and acts as resistance. You could then enter a sell order when the price retraces to the moving average line and place your stop loss above the moving average. The interesting thing about moving averages is that they can be used alone or in combination with other moving averages. So when you place 2 moving averages on one chart with different periods reflecting a short-term and a longer-term trend in price, you have the opportunity to trade moving average crossovers. They can be used to determine when a trend has changed direction. Let's show you what we mean. On a daily chart for the pound US dollar, we will now place a 10-period simple moving average and a 20-period simple moving average. When a shorter period moving average crosses above a longer period moving average, it can signal that the trend is changing direction to the upside and it may be a good time to buy. When a shorter period moving average crosses below a longer period moving average, this is considered bearish, a signal that the trend may be changing towards the downside and it may be a good time to sell. No matter which two time periods you use, this principle will remain the same. To recap, a moving average is a lagging indicator that can help filter out the noise from random price movements to see the average value. It can help identify the trend direction, determine support and resistance levels, and can help confirm a trend reversal when looking at moving average crossovers. It is important to understand the differences between the types of moving averages and how to tailor the time period to best fit the trend being followed in order to gain the maximum benefit from this indicator. Thank you for watching this tutorial on moving averages. Don't forget.
All right, let's switch back over to Webull really quick. Now, we've been talking about the daily chart, but let's take a look at some like the 1 minute and 5 minute charts for day trading, strategies. And so let's switch over here to the 1 minute. Now, pre-market is good information. Now, well, let's go back to talking a little bit more about the application first, because this information might be new to you. It's possible that you may be just using the Robinhood application. You haven't yet started using a different application. Now, there's nothing wrong with using two applications at once. In fact, it'll benefit you. I recommend using Robinhood application and Webull or some other application, as long as you have more tools, the better. It's like working with both hands rather than using one application. It's like working with one hand. It's just not as productive. And so, but Robinhood is still a great application. It's very user friendly. It's very powerful. It executes very, very nicely. But you still need something that can provide you, advanced information, advanced charts, graphs, and whatnot. And you can utilize one program for long-term investments. You can utilize the other program for day trading. However, if you're limited to how many day trades you have per week, which is the federal regulated rule is 3 day trades per 5-day trading period per application. So you have 3 day trades on one application, you got 3 other day trades on the other applications. If you have a third one, there's 3 more. So you have 9 day trades per week. And so you can just really utilize things for your benefit, and you can use one of them for your primary charts and stuff. And so when we're looking at and this is Apple using the 1 minute chart last Friday. And so if we're day trading, we can kind of look at again our indications. And so if during pre-market, and you have your shaded area here is your pre-market, and then once the stock market opens, then you're right here in the darker area. You can kind of see the volume bars right here. There's a lot of buying activity, and then it kind of starts to kind of slow down into a majority of selling activity. It's all red right here. So when it's up like here, you especially if you're in a stock options, you can bet against Apple and start buying puts really quick, because from here to here, it's only been 2 minutes. So I mean, the price rises, people are trying to buy, and it just loses its momentum. And then you can see that the price line touches the first moving average line, letting you know that it's getting ready to, it possibly could start downtrending, and watching the MACD down here as well. And then it starts to have a transition right here from green to red. The 2 moving average lines are now met together right here, a little prematurely from the price line above here. It's crossed over 3 now, indicating that now there's a 50% chance it's going to go up, or a 50% chance it's going to go down but the MACD is saying, no, I beg to differ. This thing's going to keep going down. And then so the price line now reaches the third moving average line here, indicating it's got a 75% chance it's going to keep going down and a 25% chance it'll bounce back up. But the MACD is like, nope, this thing's just going to keep going down for a little bit longer. And so, there's just several areas here you can buy puts on, and then write it down until it crosses over. Now, there's a little bit of a, maybe a false indicator here, and so that's where you may have to switch over to the 5-minute chart, because again, you might not want too many signals, or maybe adjust, because I'm using the EMA, so you may have to adjust that to the MA. So, but the 5-minute chart can easily adjust that. Let me get back to the Friday right here, and so indicating kind of 2 points right here, and then it just. But ultimately, you really want to wait for 1 hour after the stock market opens. That will help eliminate some of the volatility. So the first hour is going to be basically in this zone here. So you kind of let a lot of this volume activity kind of mellow out, and then it indicates over here is then where you can buy your calls, or you can buy it as a share, because now it's getting ready to reverse its trend. It looked like it kind of did it right here, and it kind of fumbled a little bit, but it definitely was ready to start reversing its trending direction. And so and that's where you can start buying your calls. And again, like this is about approximately, this is actually about 2 hours after the stock market opens. So 1 hour is going to be about right here. Let's see, right. Yeah, no, this is about 1 hour right here. Yeah. So, and that's another rule is the ABCD pattern that we'll talk more about next week. But the ABCD pattern, this is basically your C point. Your C point is to basically wait at least approximately 1 hour, let the volatility out, and that is for the most safest opportunity amongst anything around here, especially if you're in the stock options. The first hour is holds some of the most depreciating and most time decay period. And so if you avoid that, and as a day trader, you can buy your call at the C point, and then you can sell it once it indicates when to sell. And so these are just really, really important factors to really indicate your buying and selling decisions. A lot of times, when you don't have as much volatility, there's really only a few signals throughout the day. And so this was Thursday, using the 5-minute chart. Really, you had an uptrend right after opening here, and a downtrend, and then that was it. And so it's just really important, again, that you utilize this for your benefit. Anybody have any questions about moving averages? Feel free to unmute your mic, or you can chat in the chat room. If you don't have any comments or any questions, then I'm assuming everything makes sense. Once everything makes sense, now it's just a matter of what stocks to use this ability on. And it's really important to really know things before they happen, but also right before they happen. While it's happening, but definitely not after it's happening. And so let's go back to the website here. There is a website called market watch and pre-market. So I use marketwatch.com for the pre-market tool because it eliminates penny stocks and stocks that that really are compatible with stock options. And so on the bottom of the page, you will see the most active pre-market stocks. And these are all basically your blue chip stocks with high market capitals. And so these are the stocks that we need to focus on because they have a much smoother algorithm. Whether you're into stock options or not, looking at some of these pretty big swings can be profitable, whether you're gaining 5% or 10% using shares, or in the options world, this can be huge. You can gain 100% in just one day trade just by knowing this information, because part of our rules is to find stocks that are highly active, high volume, and stocks that are going to be on the news or will be on the news. There's this old saying that goes, buy on rumor, sell on news. So the idea is to own or to be in that investment before it's mentioned on the news, because once it's on the news, then usually the people that are holding are selling because it's at the high point, and then you have other newer investors and traders that are just now buying in, thinking, well, that's good news, it's up 5, 10, 20%, it should still keep going up, but then all of a sudden it goes down. They're like, wonder, how come it's going down? Well, most investors in Wall Street just know this rule: buy on rumor, sell on news. And so sometimes when a stock is already up, especially very high, most likely there's going to be some good dipping points. And so that is a good opportunity to bet against the stock, especially early in the morning when there's a lot of volatility. And even though one of our rules is to the ABCD pattern, buy at the C point, that's again just for a certain risk level. But once you start building up enough experience, we can trade within that little 1 hour period after opening. And so, but we just have to know what stocks to day trade. And this is one of the tools that's letting us know, okay, we need to day trade Netflix. And this is Friday's information, Friday morning's pre-market information. So Netflix and Peloton, and then we have Apple. So all of these are a huge amount of volume that I would say is more than average, because I believe average with Apple would be right around like 1.5 million for pre-market. Now Netflix is on here because they had earnings on Thursday evening, and it was pretty. It didn't seem like it was all that bad, but the reaction was pretty, I would say, well manipulated, and which is a good opportunity for a lot of volatility to either buy calls and puts, because there's just going to be a lot of selling and buying signals. And so and just Apple doesn't move a whole lot, and so Apple will always see Apple on the top of these lists because it is the most favorable stock and stock option for day traders, because the algorithm is very smooth, it's very predictable, and the payout is phenomenal. Every 1% Apple moves up or down is like a 50% gain or loss in the options world, and so it can be pretty severe. And so but when we look at this daily, we can see certain stocks that are regularly on here and stocks that are not normally on here. And so when those that are normally on here, again, those are the ones that are day traders like to trade. But when you start seeing things that are not on here, that is that's like a red flag. Not so much as a bad thing, but it's an indication that there's something unusual activity going on with that for some reason. It could be something flying underneath the radar, something that hasn't quite happened yet, but there could be some insider information or trading or whatever. And so, maybe it is on the news, or maybe there's something that they're revealing or doing or merging. I mean, there could be all kinds of things, like the earnings or whatever. And so that can create some activity, but it's our sign of what stocks to really focus on for the day before the day starts. And so, but the best time to really start zoning in on this is probably the 30 minutes before the stock market opens. And so, because if we start looking at it too early, certain things that are pretty active may be on the bottom of the list, but when you start refreshing the list, maybe every 15 minutes or so, whatever was on the bottom of the list may trickle up the list, and that is a very good thing to stay alert of, because it's just nonchalantly just trying to sneak up in there, and so we got to watch for that. And so because this is like our radar. We got to always watch the radars and see what's going on, because we don't want to miss an opportunity. And so with Netflix and Peloton being on there, let's pull that up on Webull. Let's see. Let's do Peloton, because with the market being so bearish on Friday morning, Peloton was really the only stock that was up. And so what we need to do, and to always focus, is to try to go with the flow, follow the money, whatever the market's doing, and so if Peloton is up, that's our first thing that we need to focus on. And so over Netflix, because when Netflix opened, which we'll look here in a moment, it just kind of kept going down before it indicated a little uptrend indication. So Peloton was first, because and so this is the 1 minute chart. So as the stock price, or when the stock market opened, the price quickly had surged up about 5 minutes, and then the next 5 minutes it kind of went down, and then the next 5 minutes after that it went up, and the price was up here, and it basically formed a pattern, which will educate you guys more on patterns here in the near future. But it formed what's called a double top pattern, which is a bearish pattern, indicating that the price is going to come down for a little bit. So as the price kind of comes up, forms a first point, then down, then a second point. We just have to monitor, because it could be the head and shoulders pattern, where maybe the price then comes up a little higher than the first point and then comes down. But it didn't. It did a double top pattern, and then it quickly came down here. And this is a good indication to then start buying puts. We got the information from that website, Market Watch. So we buy our puts however much that we can, and then we ride the wave all the way down. Now this stock was up it was up 10% up here, and then over here was 8 and 7%. And so when we started buying puts here, as it started to downtrend, it reached 0% right here. To going from 8% to 0% in the options world, that was 100% gain. That was amazing. On one of the most bearish days of the week, most everything is in the red, and you just doubled your investment just by using this system. And then so as the price line comes up, or even the MACD is saying, hey, it's time to sell, time to get out. And then we sell right here prematurely. It's cut through, I would say, enough lines. 100% gain. We don't need to be that greedy. Buy the fear, sell the greed. When it's all bloody and red, You just got to go with it and utilize it for your advantage and take advantage of this volatility. And so as the price line had cut through the first two moving average lines, again, that is your 50-50 chance where it says 50% it's going to keep going up, 50% chance it's going to go down. The MACD, says it's going to keep going up. And so this was a great area to sell the puts, and you can buy the calls at a certain point, especially when the price line cuts over here. We can now buy the calls because now we're betting the stock's going to go up. And so this is a great play last Friday for day trading because the price line maintained itself above the bottom moving average line up until the middle of the day. Great area to sell and to go from from here it was like 2%, and to go from 2% to I think here was like it was like 10% or 12%. I mean it did a really good job, and you could have doubled your profit again 100%. So now you're at 200% by 2 day trades in the matter of just several hours. And so but then you start losing some of that volatility throughout the day because typically the first hour and the last hour of every day is you're going to see the most volatility. And so even though we didn't see a whole lot of volatility at the end of the day with Peloton, early in the morning was great. Get in, get out. Then you can form a swing trading strategy, which is what we'll talk about here next. What to look for to swing trade. So pre-market again was the market watch. I'm going to switch over to the web browser here really quick. Everything makes sense so far? Anybody have any questions? Pre-market stuff, moving averages, everything makes sense?
Well, with Beyond on that last chart, what was the signal? I mean, what is it? Was it a double bottom there before it decided to go bullish?
Beyond, do I have it on here?
Or was it a MACD signal? Was there any confluence there?
What did you say? Beyond, like Beyond Meats?
Yeah, it wasn't. Or Peloton. I'm sorry.
Peloton.
I'm sorry.
What was the question?
Was it before it got, is that a double bottom there?
Oh, like before it closed?
24.37 point on the left?
Oh, yeah.
Before
definitely.
It started going bullish?
So, yeah, definitely a good find. Because I believe I had mentioned that in our chat because I'll try to send over some indications within the chat rooms. But yeah, there was definitely a double bottom. There was at the time, this part here was down at the same point. And so it's just the reverse as the double top. Double top is a bearish pattern. Double bottom is your bullish pattern. And so as your pattern was providing you that information, hey, it's going to go up. The MACD was telling you the same thing. And then we had the price react to both. So it's just a great way to kind of stay observant to look for these signs. But you have to be able to know what all those are, but also to imagine like a square box around certain things and to also look for your indicators. And it becomes a much easier the more that you practice. But when I discovered this, many years ago, I didn't think that I needed it. I was using Robinhood and I didn't think I needed this. But throughout the year changes. The year has different algorithms and different seasons. And then you have your bullish season, bearish seasons. So obviously, thinking everything's going to go up doesn't work. Things go down, and we have to be able to react to it. We need to be able to profit from it. And so to be able to get different results, you have to try something different. So I then was like, okay, I need to study moving averages. This is obviously the foundation to every strategy. So I give in. I'm going to start learning it. That way I can get different results. And it was a game changer. And so, but I didn't always want to practice or to utilize it when the stock market was open, because I felt like when the stock market was open, it was like the Super Bowl. You don't practice during a major game. You need to practice during a practice time. So how do you do that? So at the time, Webull allowed us to view the moving averages, but it wouldn't allow us to trade, but Robinhood would. So what I started to do, I started using the Webull, the advanced graphs and charts, but I started to trade cryptocurrency on the weekends or when the stock market was closed. It was great practice. It was genius. However, you don't get the the major volatility because you don't have an open and close with cryptocurrency, but you still have a good downtrend. And so utilizing maybe the 5-minute chart, with Bitcoin, you have unlimited day trades, and there's no restrictions on how much a dollar amount that you can trade. You can trade $1, you can trade $10, $100, or whatever. So what I decided to do, I started to kind of maybe, do a day trade during breakfast, and maybe one during lunch, and maybe another one before bed. And I noticed utilizing the 5-minute chart, when I waited for a buying signal, like we kind of see right now, I would buy in and wait about an hour, and it would, do its thing, and then it would provide a sell signal, and then I would sell. And so I noticed it was kind of like a 1-hour algorithm. You had a signal there, you got a signal there, you got a signal there, another one there, and so I was like, wow, this is pretty easy. And it just kind of became, and then so when you start getting into the stock market, it's like, you're more confident on what to do and when to trade, when to get in, when to get out. And so, and confidence is key. You need more time, you need experience to increase your experience level. And so this really helped me, and it'll help you tremendously by just putting in more practicing hours into it. That way, when the stock market is open and you're utilizing stock options, you can really maximize the opportunities. Any other questions or comments before we go into the next thing? I'm going to read the chat room here. So wouldn't it be too late to buy into an active pre-market account by the time the market opens? Well, because like I said, if Peloton was up high and then it started to fall, and what if it stayed at zero? Nobody really knew it would bounce back up. So and that's where you want to let it fall first after opening. Wait for a pattern to build to let you know if it's going to keep going up or if it's going to keep going down. And then when to enter in a double top or bottom in which time frame. So I'll pull up our cheat sheet for patterns really quick. Because Sharif has he asked on the chat room when to enter in a double top or bottom in which time frame. So you have your double top on the top left here. So where, and like I said, we saw this with Peloton early in the morning, right when the stock market opens. The first 5 minutes, it opens up and then boom, shoots straight up. It starts to hesitate right here and forms the first high point for the day. Then the next 5 minutes, the stock price starts to fall and forms a neckline. So this is 10 minutes after opening, from here to here. Like I said, you got opening here, 5 minutes, 10 minutes. Then the next 5 minutes, then it starts to trickle back up and starts to hesitate right around the same high point just 10 minutes ago. So that's 15 minutes after opening. Then it starts to hesitate and begins to fall here. indicating your double top pattern rather than your head and shoulders pattern, because your head and shoulders pattern, after the 15 minutes, you'd be up here on the higher point than the first point. So obviously it's indicating the double top pattern because now it's hesitating, it's beginning to fall here right around the neckline. So since this is a bearish pattern, we're betting against this stock. Our entry is basically right under the neckline, because if the stock price falls past the neckline, it's going to keep going until further notice. If it doesn't, we have a stop area, meaning if you're already in, that's your stop loss. Get out, because, well, if you're betting against it, because something is manipulating it. It could be manipulating the entire stock market or that stock. And so, but typically more than 80 or 90% of the time, it usually goes towards its intended direction. About 10, 20% of the time, it doesn't. So again, this is a guide that gives you a lot of great information of what most likely things are going to do. And that's what we need. We never want the unknown. And so, if you're not already in, the stop is invalid. This is an invalid strategy. Abort, focus on something else, or watch for a new indicator, or maybe bet that the stock goes up. It just all depends on what the moving average is doing. But in this case, it did exactly what it indicated. So we had to get in, enter, which is the entry point here, and the target area is our selling area, based off the moving average. We have to hold and wait until further notice, until it provides us the next signal of when to get out. And that is our system, that is our assistant letting us know when to buy and when to sell. And as well as our intelligent information, because you don't want to be that person on social media. Should I, I'm down 50 or 20%, 50%, should I buy more, should I hold, what should I do? You should know exactly what to do. And the goal is to become an independent and successful investor and trader, where you don't need anything or anyone but yourself and these little handy tools. Now the double bottom right over here on the left is basically the other pattern that it had done as it began to fall. It basically did the opposite, where once it had fallen down on its bottom, it then tried to recover. But we have to be very aware and very alert of the dead bouncing cat pattern, because we can mistake that with the double bottom pattern, and I'll talk more about that here in just a moment. And so when the price line comes down here, if the price line keeps continuing to fall past this point, that's the dead bouncing cat pattern, and that price will most likely continue to fall for quite a while. And that's why it's important to watch it bounce, because we need to know if it's the dead bouncing cat pattern or is it the double bottom pattern. So if the price line comes back up and touches the neckline, we need to wait until it passes that first, and then if it does, that indicates it's trending upwards, and your moving average indicators will indicate the same exact thing. And so all the stars are aligning now, and so indicating the uptrend is confirmed. It's time to get in until further notice of when to get out. And so if it doesn't, if it keeps falling, then again, this says, this abort this double bottom pattern, because or if you're already in, this is your stop loss, get out. And your moving average indicators will also provide that sell signal as well. But like I said, we got to indicate double bottom. Can be very tricky sometimes, or the inverse head and shoulders too, because if it falls here, it could also bounce back up. So just very, very tricky. And I'll show you what the dead bouncing cat pattern looks like. It happens a lot. It can happen after bad earnings. It can also happen during like a drug or pharmaceutical company that's been doing some drug trials, and the government says, "Oh, you guys only have a 65% success rate, so we're not going to approve it with the FDA or something." And so and so their stock price reacts to that news and then falls just like like Netflix did. And so it bounces, and then it kind of falls down here, and then again we have to be aware. Is it trying to provide that double bottom pattern or inverse head and shoulders pattern, or is it the dead bouncing cap pattern? And so, but it's important to be aware of all those patterns, that way you can try to identify which one it is. So since you guys don't have any other questions, let's go back to the web browser here and see, somebody I think has a question in the chat room. It looks like over the past week, the Dow, NASDAQ, and S&P 500 has a dead cat bounce. Oh, absolutely. And we're definitely in that correction territory. Let me pull that image up here really quick, because a lot of the system is down either 8, 9, or almost 10%, and that's kind of where we're at. And occasionally I'll try to remind the group and our members about this, and I've been doing that since the middle of November, and just didn't want you guys to be shocked when this happens. And so we're down here, and I mean the triggered event happened quite a while ago, and but it's definitely gotten worse. It's definitely escalated very quickly, and we're not done through this yet. But typically the winter season has a very bearish season throughout the year. Let me pull up our web browser here. Where did that go? We'll pull up here. It's a normal thing. So if I go to our group here, I'll type in seasons. It's definitely an article that I've posted several times before. This is the most recent one here. So the winter season is definitely the most bearish season of the year. And so this is a cold chill of the bear market, or the bearish market. Periods such as this are often marked with high volatility and company bankruptcies, trade wars, elections, and pandemics, and more. And I mean, there's just so much more. It just depends on what they decide. Again, I kind of call that pouring fuel on the fire. They're making a bearish season more bearish. So sometimes you'll see financial panic and bank runs, and people often say this is the end of the world. Of course, anyone paying attention would say that's ridiculous. The market won't be in a permanent bearish market, no matter how bad things get. In the same way that the world won't freeze over because of bad winter storm. Contrary to popular belief, it will be the best time to buy stocks. The media will be filled with reports and studies showing how bad stocks are as investments right now, unless you're Jim Cramer. This is because they are cherry picking the time period and using the events to manufacture fear and attract clicks and attention. It can be hard to buy stocks during this time, particularly because seamlessly better opportunities are out there. For example, when the interest rates spike and stocks price drop, interest rates for the CDs or bonds may be temporarily much higher than the average yearly stock market return you seek. There was a time 30 years ago when you could get a 9% interest on your money outside of the stock market. So many people didn't buy stocks. This kept stocks low for quite some time, but the investors who permanently or patiently resist this temptation were handsomely rewarded. But the thing that's we're going to be looking forward to is that springtime, where this is a time between the bear market and the bull market. The brutal cold of the economic recession, unemployment, general negativity is starting to lift. Keep in mind that there won't be a sudden announcement of this new season of the stock market. If you're following the media, you'll see that there's usually a season behind. Economic reporting outside of unreliable forecasts is done in the past tense. This time period presents some of the best opportunity for investing in stocks. Share prices are usually suppressed, allowing for many big quality blue chip companies to be purchased at steep discount. You'll start to see recovery reflecting first in the earnings, and the share price usually follows. Understand that it's always the darkest before the dawn. And if you've struggled through the winter, remember that the spring and summer are just right around the corner. It's just unfortunate that the winter season has really just begun. And so, but again, we need to take full advantage of the situation, because the downtrend, we're downtrending for sure. But again, as we were talking earlier about how to find stocks to trade early in the morning, what do we look for to find stocks to swing trade right before close? And so there's a website that I use. It's called barchart.com. And I use the options area because I day trade and swing trade options. So we'll click on the options area on the top left, or if you're on your mobile device, it would be a little, that little hamburger menu icon. You just click on that and then options, and then the most active options for right now. Now, all the information that we're looking at was from last Friday. And so, but this information is best looked at 1 hour after the stock market opens. Once it populates, the price changes and the dollar amounts and the percentage changes will change every second. But every 15 minutes after that first hour, you'll have to refresh the page, so that way the order changes, because everything's in order by the options volume, which again, volume is today's buying and selling activity. And so at the end of last Friday, it looks like Apple always dominates the list. Same thing with Tesla. And the reason why that is, just like the pre-market list, is because it's the most favorable stocks for day traders to trade, as well as to swing trade. And so every 1% Apple moves is almost like a 50% gain or loss in the options world. But even if you're not into stock options, you can still look at it as highly valuable information for trading shares, because it provides you information on activity, but also calls and puts activity. Out of this amount of volume for Friday, 52% are betting that the stock price will go up, because a call is betting a stock goes up, where a put is betting against the stock, betting the stock is going down. So 47% is betting that the stock is going to go down. So because it's near a 50-50, to me that indicates that most likely people are either a day trading throughout the day, doing both, or for swing traders, they're straddling, which straddling is where you buy both a call and a put. You're betting both the stock goes up and you're betting the stock goes down. Why would they do that? I'll explain. You can only lose what you put on the one side, but your gains on the other side are potentially unlimited. And I'll show you. We're going to switch over to Webull really quick, if I can find that here. Let's see. Okay, Webull. We're going to switch over to Webull. Let's take a look at Netflix. Now, I'm always providing you guys information on earnings, which we'll talk about earnings here in a little bit. This Netflix event was really planned. Last weekend, we knew we had a great idea of what was going to happen, and so it was a great straddling plan. There was a lot of clues of unusual straddling activity. So it was a great opportunity to buy both, betting that Netflix was going to go down and betting that Netflix was going to go up. And so what we're seeing here, I just want to point out that if you had, let's say you had let's just say you had a small amount. Let's say you had $1,000 on a call and $1,000 on a put with Netflix, a total investment of $2,000. Well, since Netflix had plunged, you would have lost 90, worst case scenario, 90% or 96% of your call. But your put, you just gain like 1,000%. So that $1,000 has now turned into over $10,000. So it washes out the loss from the one side and it puts you ahead on the other side tremendously. That way you're not just picking one or the other, you're picking both. It's a great insurance strategy, but there's just certain stocks that we got to do that with, but we have to follow the clues and everything to make sure we're doing it, and there's plenty enough information out there, and like I said, which we'll go over a lot of this stuff, but straddling is going to be great. And so as we go into earnings later here in a few minutes, Tesla may be another opportunity for this week, because Tesla, even though Netflix had a 21% movement, Tesla will most likely have, it's anticipated Tesla could have it up to a 10% movement up or down. But in the options world, we're going to see 1,000% gain on one of them. And so one of them is going to be a 90% loss. So it's just, like I said, we'll dig into that here in a little bit, but straddling, especially at this point in time when the market can be very volatile. And the reason why the market is so volatile right now is because of the Russia is on the verge of invading Ukraine. At this point in time, it just, investors like to just pull their money out, especially right before it happens, right before the invasion happens, or whatever happens, or when during it happens. So it's just really weird that I'm surprised the invasion hasn't happened already. It's not on the news. But there's just a lot of weird things going on behind the closed doors, or behind the curtains, or whatever. There's a lot of things that we don't really know about, but there's things. It just seems like things are going to happen really, really soon. And but once it does happen and things kind of start to mellow out, investors will start investing. So it's just weird how the timing is just, it just seems to happen right during the beginning of this our bearish market. And so, but things could easily bounce back up very quickly. If it falls that hard, it can surge just as quick. And so that's where, when the market is this volatile, it's just very, very highly recommended to play as many safest strategies as much as possible. And usually when one of these high market cap stocks pass 1%, it usually your straddle becomes a wash. I mean, it's usually it's a wash up, usually up until that point. But once it passes 1%, that's when the whole thing becomes more profitable. You just don't want to hold too long, because the longer you hold a call and a put, or both, the time decay and the time depreciation is what's going to kind of devalue your investment. So you definitely want to try to get in and out as quickly as possible. And I get this question a lot: what should my expiration date be? For straddling opportunities, you want your expiration date to be the soonest as possible, because you want it to be as volatile as much as possible. And the only way to make it more volatile as much as possible is by selecting the soonest date. In fact, this is the 28th. I don't have the last. We're not showing the last Friday's. The last Friday's gain was much higher than this. And we may be able to pull that up here. Let me see here. Let's go to this website here. If you're wanting to know more information about a particular stock option, there's a great website. It's NASDAQ.com, and there's a certain area you can go for stock market information. But once you kind of get there, you can also just change the ticker code in the URL address, so it just makes it much easier. stuff may have expired too. Okay. So it's not showing last Friday's stuff on there, but it may on bar chart. So let me go here. So with barchart.com, under the options area, we have the options volume leaders. Options volume leaders will provide you the most highly active individual calls and puts. And because it can update every 15 minutes, it can provide you the necessary information 15 minutes before the stock market closes. And so the most active, but then you want to pay attention to the DTE, is the number of days until the option expires. So if we're looking at this on a Friday, Saturday, or today being Sunday, we'll see 0. So come tomorrow on Monday, this will disappear. It's no longer active. It's invalid. So going into this next week, doing our reconnaissance or due diligence, we want to focus on what will be active. So right now, the one that is currently active is this $167.50 call strike price for Apple that expires this Friday, January the 28th. It's currently priced around the $1.64 per share, or $164 per contract. So that would be your price for the or these would be your midpoint, and you have your asking and last dollar amount. But then you have your open interest, and then you have your volume. Now, open interest might be new to you if you're new to options, but open interest is like an accumulation of volume activity prior to today, because volume resets on a daily basis. This will become 0, but this 47 will then merge with the open interest here. So when we are seeing that the volume exceeds over the open interest, that means that there's a lot more interest on this than before. So there's a lot of investors that are betting that Apple is going to go up as we go into Monday morning. So that's a good indication that Monday is going to be bullish, because that's another thing that a lot of pros say: follow the money. And they are investing a lot of money that absolutely believe that Monday morning will be bullish. And so that is another clue to figure out what the next day is going to be like, is by what investors are putting their money. So then we have the next one that's going to be active is this DT. I don't recall what DT is, but if you look at this daily as well, you'll know what is normally on here, like Apple, Tesla, and whatnot. But the DT is not normally on here, so that we got to consider that unusual activity. What is making DT so active? We got to check its charts. And we have 2 calls. Its current price is $48.49. We have a call, meaning that people are betting the stock's going to go up. We have a $50 strike price that expires in mid-February. Then we have a $55 call strike price that expires also in mid-February. So, but with the first one, the $50 strike price had no interest at first, and now all of a sudden it's got a lot of interest. This is highly unusual buying activity. And I mean, it's just so noticeable too. This is like, it could be flying underneath the radar. So we got to figure out what is going on with DT. So let's put that on our watch list. This will be great homework to start doing some research on this. And again, this website is at barchart.com under the options volume leaders section. So highly recommend bookmarking this, because this is very, very valuable information, and it's free. It doesn't cost you anything. And so next one is there's another Apple call, and then there's another, that DT, we talked about that one. Next one, another Apple call, $165. just very, very bullish characteristics that we're starting to see here. Now we have a PBR. I can't remember what that one is, but it's currently at $12.67. People are betting that this stock is going to reach $20 in next year. And so even if you're not into options, you can still buy this as a share, because as a share to go from $12 to $20, that's like an 80 or 75% gain, just to hold it. And they could pay a dividend as well. So that's another one that we got to research to figure out that is this a good long-term investment, especially during this very bearish season. A lot of people are very bearish on this. Here's another food for thought. Check out the open interest. It's 94,000. Now we have volume of 30,000. Now, so the open interest is very high. It's already had a lot of interest. We got to figure out what's going on with this, because maybe people are dumping it. Because again, volume is buying and selling activity. It's just with options, it's always hard to tell. It just doesn't provide your graph like looking at a share. Sometimes your application can show you, is it a majority of buying activity or is it a majority of selling activity? So we kind of have to put some numbers together to try to figure out, is it selling activity or buying activity? So looking at the price and whatnot, which we'd have to look to see if the price is up or down. If it's down, people are most likely they're probably getting rid of it. They're losing money and they're getting out. But because the time is so far away, most likely they're buying. They're buying more. They're buying more interest, and the interest is going to continue to accumulate. So that way it becomes a very high open interest stock option. Now, a lot of times, because this page is always sorted out automatically by default by volume is today's buying and selling activity. But if you're more of a long-term investor into whether shares or short-term investing into stock options, click on open interest, this open INT, click on it, and it will automatically sort it out so that way you can see the highest open interest. But we got to make sure that it's still open. And so so you have that one. Out of everything that is currently open or active, that one seems to have the highest open interest that's currently active. I'm surprised there isn't more. It's just all the open interest is just so low. That's weird. I'm surprised we're not seeing more ones that are in the 100,000 area. So that is kind of unusual. Very, very, very unusual. Now there's also ETFs. You can also check those out. A lot of people always trade SPY and Apple. Now SPY has 3 expiration dates per week. The SPY has a Monday expiration, Wednesday, and a Friday expiration. Now we can click back on most active options, and then we can see the most active stocks and ETFs. We'll go ahead and we'll click on ETFs. Now SPY is basically your S&P 500 kind of market thing that people like to bet that it goes up and down. But a lot of people will typically will straddle SPY. And so, but right now we can see that a majority, 57% are betting against the market, betting that the stock market is going to continue to go down. Normally this is 50-50 or near 50-50. NASDAQ looks like it's 50-50. Then you have your Russell 200 or 2000. Definitely very bearish. But then let's click back on stocks. And then, so Apple is, like I said, very dominant on that list. Then we have Tesla. Tesla was down 5%, 48% betting the stock goes up, 52% betting against the stock. So there's just a lot of straddling activity here, I think, overall. from what it looks like. But when we're looking at with Friday, but looking at the individual calls and puts, again, like I said, looks very, very bullish. It looks like Monday morning could open up, pretty good, as long as the invasion hasn't happened yet. But even though Monday morning can open up in the green, it could still easily fall as more and more investors are scared and get worried that the invasion can happen at any minute and on short notice. And so I think we're going to continue to see a sell-off, and as well as more volatility. And like I said, we need volatility to make a tremendous amount of gains. So AMD was third place on Friday. It's still almost near 50-50. Peloton is right here. Peloton is very bullish. 75% we're betting the stock is going to keep going up that day, as well as for Monday, where near 35% were bearish, betting against the stock, also thinking that it could also come down Monday morning. Ford was fifth place, and so they're up 59% betting that the stock's going to go up. So a lot of these are commonly on here, but like I said, we can also try to find ones that are not normally on here, but also looking for things that are unusual. Sometimes we may see a very high percentage rate on one side or the other, but right now, I mean, everything is almost 50-50, which is really weird. We see a couple like 60-40s, but not very many. 60-40 would be like a Peloton. We have a Ford, and then almost a Lucid. And so, but yeah, things are really 50-50. So that indicates that investors, they just don't know, that they're uncertain, that they're maybe straddling. They're proceeding with caution. We're seeing a very, very weird, unusual behavior than what we normally see with the stock market. Now, it's highly important to, when we're also looking at this stuff, to also look at straddling and strangle activity. Now, again, when we're talking about straddling, strangle is basically the same thing. It's the same concept. We're betting the stock goes up, we're betting the stock goes down, but straddling is the same strike price. Let's say, whatever that it is, it's the same strike price for going up, same strike price to go down. Strangle is also betting the stock goes up, but betting it goes down, but different strike prices. Especially if the stock price is kind of in the middle of something, you can have different strike prices, but keep them kind of the same dollar amount distance from each other. Like Tesla, what is Tesla? So Tesla right now is at $943 a share. So let's take a look at Tesla's most active stock options for Friday using the NASDAQ website. So again, the price for Tesla was $943 a share. We're looking at Friday's most active calls and puts. So strangle would be like, maybe you had a $1,000 call strike price and maybe a $900 put strike price, somewhere in there. But you can try to also follow what is most active, but looking at this information on the NASDAQ website, before they redesigned their website, they used to have the expiration date on here. You'd have to click on it, the next page will show you, but you can also look at the value of it, and if it's really, really low, most likely it's expired and expired worthless. It is no longer valid. And so obviously that the 930 isn't valid anymore, the 900 there isn't valid anymore, so we'd have to find maybe a smaller one. There's a 940. We'll see if that one is active or not. So this one is expired. You see the expiration date right there, January 21st. Let's try the 950. So the 950 is also expired last Friday, January 21st. There's a 960, anything lower. There's a 945. Let's take a look at that one. That's got some value to it. That one's also expired. But we can also look at this information on tomorrow, because all this expired stuff will be gone. We'll see a new set of active information. But it looks like right now that I think that was expired. Yeah. So it can be great information to look at. Everything on here looks like it's pretty expired at the moment, but at least it can provide us information on what individual stock options people are doing before the earnings date. And so, but like I said, we'll dig into that here in just a moment. But as we're talking about straddling and strangle, again, we need to always look at this information before closing, and that's 15 minutes before the stock market closes. So when we click on the one, we have short and then we have long. So short meaning the expiration date is going to be a short term versus long term. So again, we want to look at both. And so what we're looking for when we click on here is duplicates of the same stock on here. So we want the same. The more that we see of the same one, the more of an unusual activity that it becomes. The more things are kind of flying underneath the radar, and this is our guide. This is our radar system. We got to be aware of what's doing what. And so again, we're looking for multiple things. So we'll start from the top and work our way down. So you'll see the same thing. We have T there, Microsoft. Let's see. Okay, two Microsofts. We got a Microsoft there, and a third one there, fourth one there. So we got 4 Microsofts right here for straddling. So boom, obviously, so that is now on our straddling watch list. Going into Monday from Friday morning. But again, like I said, this changes every day. So we always got to be aware of what's going on. So the weekend holders are doing Microsoft. Let's keep going down, see if there's any more of the same thing. We got Twitter there. Okay, so what I'm seeing on this page is just Microsoft for now. So we got Microsoft is now on our straddling list for Friday before close. So we click on long straddle, see if there's any duplicated stocks on there. We start from the top. So I just got that one there. See anything there? Dolby, Nvidia, just the one there. WPA, no. We got a couple AMCs and Tilray. So we have 3 AMCs and 2 Tilrays. So got to put that on our list. But so far, Microsoft had the majority. We'll click on short strangle. And then again, we need to find multiple of the same things. We're starting from the top, working our way down. Now we have Hood. This is the Robinhood app using the stock market. So we got 1 there, 2, 3, 4 on our single page here. So Hood is now going on our straddling list because there's a lot of them. So going down the list, see, we got another Microsoft. We got 1 there, 2, 3, 4, 5. We got 5 just on this page, 4 on the other. So that's, so far, Microsoft is on the top of our straddling list. Hood, I think is, there's 3 of those, 4 would be second place on our straddling list. And then the others, would follow along. And then the long strangle, we'll click on there. and then we'll work our way down, and we see 3 Activisions. We have 1, 2, 3. So that is now on our straddling list, and then AMC dominates the long strangle, and looks like some of these dates are, for March, or some of them are or for next month. So February, March. So AMC is obviously on the straddling list. So it's not very many, but they do change from day to day, and you will notice right before Tesla reveals their earnings reports that we're going to see a lot of Tesla straddling unusual activity on here. So just be warned, not really warned, but just be alert. The more you learn, the more you're going to earn. And Benjamin Franklin used to say, if you fail to plan, you're planning to fail. And our goal is definitely not to fail. We need to plan, and we need to be alert. We need to be ready. And the only way to be ready is to do our meetings and do our due diligence, and to plan ahead. And that's what we're doing. And so every Saturday, I'm always posting in our group. How do I get back in there? Let's see. Every Saturday, I'm always posting things, and every post that I post always goes in our featured areas. Because when I created this group many years ago, it was more or less like for my bookmarks. Whatever I was researching, I can bookmark it in our group. That way, I can always go back into it later. And so every Saturday, I post the top 10 most anticipated release earnings, as well as the schedule. So you can always click on it. You can pull it up right here. You can see Monday, Tuesday, Wednesday, Thursday, and Friday, whether it be before open or after close. So there's a lot of big names on here. There's going to be a lot of activity. And then it's really, like I said, great to be aware, because earnings season is really kicking into gear. So it's going to be very interesting. A lot of people may think this could be very bullish activity, but again, like I had mentioned, they're going to talk not only quarterly stuff, but they're going to talk yearly stuff, and yearly stuff spooks investors and Wall Street. Things are just mentioned that they just don't want to hear, and so we'll see a lot of bearish characteristics regardless in our bearish season now. So but there's going to be a massive amount of volatility, and that's what we need, especially for us that are doing straddling strategies. But every either Saturday evening or Sunday morning, I'll put the top 10s analysis in the group. And so Verizon, which is confirmed to release its earnings reports on Tuesday morning before the stock market opens. The company, and I'll try to highlight certain things within the paragraph, because some people, they just read this and it just like goes over their head. So I'm trying to point things out that are really important about this stuff. And so the company's earning release has a 45% expecting an earnings beat, which is terrible. That's terrible. And so if you're holding shares, you might want to think about getting out, because especially it's most likely the graph is downtrending. And over here, pointing out that the option traders are pricing in about a 3% movement on the earnings. That meaning it could go up, it could surge 3%, or it can plunge 3%. But an average stock is about 6.5. So it's not a very big mover, but it's just giving you a lot of great information. And so General Electric is confirmed to release their earnings Tuesday morning before the stock market opens. The company's earning release has a 42% expecting an earnings beat, which is terrible. Now, average percentage, when you look at this stuff regularly, is about 65%, which is about the average of what a call ratio should be, not 50%. That's just telling us, there's a lot of bad things that are about to happen. The option traders are pricing in a 6% move on earnings, and the stock averaged a 2% move in recent quarters. So, but option traders are anticipating that there's more volatility this time. AT&T is confirmed to report their earnings Wednesday morning before the stock market opens. The company's earning release has a 51% expecting an earnings beat, which is not good. Very unknown with this one. Though option traders are pricing in around a 4% movement on the earnings, and the stock has an average around a 2% movement in recent quarters. Halliburton is confirmed to report their earnings tomorrow morning, January 24th. The company's earnings release has a 59% expecting an earnings beat, which is not bad, especially as we're kind of more or less not only going into the bank season soon, but we're also at this point in time where energy is very demand. It's very valuable right now, and if Russia invades Ukraine or whenever they do, the barrel of oil is going to go up. It's around $80 a barrel now. It's going to go over $100. In my area, well, I live in the Seattle region, and a gallon of gas is around $4.25 to $4.50 a gallon. But I travel to California every once in a while, and it's as much as $6 a gallon down there. So we're going to see in my state of Washington, we're going to see a gallon of gas reach $6 a gallon, and in California, a gallon of gas is going to be like $10 a gallon. This is going to get nuts. And so, but these oil companies, it's going to become very valuable. So it's a great time to probably start focusing on oil and energy right now, because the cost of energy is predicted to go up by analysts, but also certain algorithm things and charts that I've shown you guys before. I don't seem to have it on my desktop. I have it on my phone, but we can talk more about that later. But yeah, just know oil energy is going to be pretty big pretty soon. Next one is the Johnson & Johnson, and so they are scheduled to release their earnings report Tuesday morning before the stock market opens. The company's earning release has a 58% expecting an earnings beat, and option traders are pricing in around a 3% movement on earnings, but the stock has an average almost around a 2% movement, so it doesn't move a whole lot. Now Intel, again, we do have a shortage on microchips, but why do we have a shortage on microchips? Because of the rare earth materials. So even though microchip companies, you'll think that they're always a good thing to invest in, which they are, but they've really, when you look at a lot of their graphs, you can kind of see that they've really peaked. They're downtrending right now. And they really ultimately can't get enough rare earth materials. China has really cut us off quite a while ago, and that's hurt. So we've had to really develop more mines throughout the world, especially Australia, to mine more rare earth materials for the Western world. And so all that stuff's in progress, where Intel's confirmed to release their earnings Wednesday morning, January 26th. The company's earnings release has a 51% expected earnings beat, which is terrible. That's just absolutely terrible. Options traders are pricing in around a 7.5 movement on earnings. The stock has averaged almost a 10% movement in recent quarters. That's a lot of movement. And that would be a great one for straddling, because like I said, it only takes like 1% movement or so, even if there's, which can affect in options, something called implied volatility crush, also known as IV crush, can devalue your stock option, no matter which one that it is. with even if it's a very little amount of movement, it can affect it tremendously. So to try to avoid the IV crush, or the implied volatility crush, you need to look for stocks that have this big movement. And so Intel looks like this would make a great straddling opportunity. However, we also saw Intel had one on the, I think it was the straddle strangle on the short straddle. There was one and it was on the top of the list right there. Boom. There wasn't multiple ones on the list, but I did notice it. I don't know if you guys noticed it or not, but it was here on the top of the list, which I believe it'll indicate come Monday we'll start seeing more Intels on the straddling list. So this is just, I think, the first to come. It's just probably investors are probably just waiting to see if Intel's going to be maybe even lower Monday or whatever. I don't know, but this is just what the activity is looking like. So we're connecting the dots here. So Boeing right here, and sometimes the pictures I post may show some clues and signs, and you might not know that Boeing does invest in the military. Like I said, there's a lot of military movement, there's a lot of military stuff going on, but also our military's upgrading a lot of stuff. And our government wants to go more autonomous. This is an autonomous unmanned aircraft, and it's phenomenal, all its specs and stuff, and Boeing makes it. And even though they're not always focused on passenger stuff, but also stuff for the military, like I said, there's a lot of military stuff activity going on. We're supporting Australia with a bunch of stuff, and other European countries and whatnot. So we're really increasing our own and upgrading our hardware. So Boeing is confirmed to release their earnings report Wednesday morning, January 26th. The company's release earnings has around a 52% expecting an earnings beat, which is also terrible. Options traders are pricing in around a 6% movement on the earnings, and stock has averaged around 3% in recent quarters. And so we may see Boeing on the straddling list, especially if investors really do anticipate around a 6% movement. We could have some pretty great gains straddling this one. So Microsoft is it's going to be on the news all week long. I mean, Microsoft buying Activision and whatnot, this and that. And so Microsoft is confirmed to release their earnings report Tuesday after the stock market closes. The company's earning release has an 83% expecting an earnings beat. You're like, whoa, 83%. That's way above average, because average, like I said, is around 65%. Microsoft holds the highest percentage possibility that they're going to beat their earnings and their revenue, and the stock price is most likely going to go up. So the option traders are pricing in around a 6.5% movement on the earnings report, whether it be up or down, where in recent quarters there was around 2 to 3% movement. And so there's just going to be a lot more volatility with this one. There's just going to be a lot more news. I mean, all eyes on this one. Microsoft definitely, and again, we saw a lot of straddling activity, and just with a 3% movement, that's going to be very, very profitable straddling this one, or even if you don't want to, 83%, you can just buy calls. And because if you convert that into odds, you have 4 out of 5 odds that this stock is most likely going to beat its earnings and the stock price is going to go up. So that is great versus a 50-50. Well, that's not good. And so, we gotta really know what's going to happen throughout the week. And then we have Apple here. Apple is scheduled to report their earnings Thursday after the stock market opens on January 27th. The company's earnings release has a 71% expecting an earnings beat, which is just slightly above average. That's not bad. That's pretty good. We definitely like to see a little bit more, but then again, when we're Apple's revenue primarily comes from the Apple iPhone and a lot of their merchandise. They make a little bit of money from their services and whatnot, but it's primarily their merchandise. And to be able to make stuff, you have to have stuff, and you got to have the materials, and there's a shortage in that stuff. As well as staff and people in factories and material, and a lot of the materials we get comes from China and other places, and so when we've looked at our quarterly and our monthly economic reports that we always go through, the retail was down. I mean, it was terrible, and so I would anticipate that Apple products are also going to be down, and so I'm very hesitant. I think this should be more of a 50-50. But obviously, putting all the numbers and stuff together, it equaled out 71%, and so that was pretty good. And so hopefully, Apple did very, very well throughout the fourth quarter and the holidays. And people bought iPads and whatnot, and phones. But option traders are pricing in around a 5.5% movement on earnings. The stock has averaged around a 3.5% movement in recent quarters. Tesla, though, is going to be probably the most volatile one out of all of them. It's always very active, but Tesla's confirmed to report their earnings Wednesday, right after the stock market closes on January 26th. The company's earning release has a 74% expecting an earnings beat, which is very, very good. And Tesla had a great, sales and delivery reports for every month and the fourth quarter. So this is great. This 74% is definitely considered above average. And this is going to be, huge. And so option traders are pricing in around a 10% movement on earnings, whether it be up or down, or it normally averages around 3% movement in recent quarters. So there's going to be a lot of volatility, because not only are they going to talk about the last quarter, but Elon Musk is very smart. He knows to also talk about the yearly stuff, and he's going to say, oh yeah, we had a record-breaking year last year compared to any other year. We sold 1 million cars, record-breaking, blah blah blah, and investors are going to get off on that. They're buy, and this thing's going to go up or whatever, And so and their stock, Watch's stock price hit back up at $1,200 again. And so this is going to be a lot of fun, but like I said, you got to do this right. Don't mess this up, you guys. Let's play safe. Let's make a lot of money. This week you guys can easily make $100,000, easy. So let's definitely let's play it safe. And so let's get into economic reports. We need to know what this week is going to look like. And for a while, it took me a while to figure out, because you always said, like I said, follow the money. We got to know what makes things work, what makes things tick, blah blah blah. What affects the stock market the most? And so the number one thing is obviously international issues, and the international issue right now is the Russian invasion with Ukraine dominates any other influence to the stock market. Not only do we have the issue with Russia invading Ukraine, but we also have a possible issue in the back of the investors' minds and whatnot that China could also invade Taiwan at the same time. If Russia invaded and then China invaded the other one, it's a lot at once, and I don't know if the world would be able to really respond quick enough or rationally, or I just don't think they would really do it. I don't know. There's just a lot of uncertainty, going on. But that stuff, like I said, just really dominates the influence of the stock market the most. So it's very important that we are aware of that. But for the majority, the economic reports influence the stock market, the most of the time. And so we have to know what each economic report is, how it affects the stock market, and when it will affect the stock market. So, and investing.com is a great resource for that. And with the right settings, we can kind of customize things. But it's also an application that I highly recommend that you download in your app store because it's free, and it also alerts you with very important news and other things. But you can also look at your U.S. futures and pull up other calendar things. But for right now, an economic calendar is what we need to talk about because it really has a big impact on the stock market. Now, we need to filter things. If you're on the website, we got to click on filters. If we're on the application, it looks like a funnel. You have to click on that. We need to clear everything. So click on clear. There's only two things that we need to see. The first one is the United States stock market. And then the second one is under importance. We will see 1 star, 2 stars, and 3 stars. You want to put a check mark under 3 stars because we want to tell this website that we want to see everything that will have the biggest impact on the United States stock market. Once you have those two selected, click apply. And then we want to click on this week because we'll be able to see everything that's scheduled to happen that will have the biggest impact in the stock market for this week. And so remember, Benjamin Franklin said, if you fail to plan, you're planning to fail. So we need to plan and be ready for this week so we'll be completely profitable and maintain our gains consistently every single week, no matter what happens in the stock market. So Monday, there's nothing scheduled for Monday. So obviously that just depends on, investors and the media and manipulation and whatnot. There's just really, the government doesn't really have anything. But again, there could be a schedule for the White House where Joe Biden or somebody could talk about something. They could talk about the pandemic or whatever, they could talk about anything. So we have to know what's scheduled for the White House as well, because those speakers can manipulate the stock market. So it's very important to also have the schedule down for the White House. But with Monday, as we're looking at a lot of the activity from Friday before it closed, a lot of people were buying calls. They were focusing on calls going into Monday. So Monday morning looks very bullish for the most part based on that information. And so far, like I said, there hasn't been any invasion yet, so we should be fine as long as things continue the way they are now. But Monday, throughout the day, like I said, that's to be determined. We got to look at the algorithms and see what it does. That way we can, plan accordingly to that as we reach the closing time on Monday. And then on Tuesday, we have the CB consumer confidence for the month of January. And so when we look at the time on the website, this is Eastern time where Wall Street's at. So you have to plan accordingly to your time zone. But when you're looking at it on your app, on your phone or your tablet, it should pull your time zone. So just know what time the stock market opens and closes based on your time zone, and just plan accordingly to the timing information. So timing is key. It's a very, very important. Things are time sensitive, and so a lot of times you'll see volatility happen right before the economic report is released, and then you'll see volatility after the economic report is released. It just depends on what happens. Now, if you're not exactly sure what any of these are, feel free to click on them, and it will pull up a new page or where you can kind of read a little bit about it. It's just a small paragraph. It's very, very brief. It's very nice so the CB Consumer Confidence is your conference board. Your conference board consumer confidence measures the level of consumer confidence in economic activity. It is a leading indicator as it can predict consumer spending, which plays a major role in overall economic activity. Higher readings point to higher consumer optimism. A higher than expected reading should be taken as a positive or bullish for the US dollar or the stock market, while a lower than expected reading should be taken as a negative or bearish for the US dollar or the stock market. Most reports need to be up. but some reports need to be down, like crude oil inventories or unemployment. The lower these numbers, the better, because it means that it's better for our economy. Unemployment, if the numbers are down, people are at work, they're working, they're being productive, they're paying taxes, they're helping the economy. If they're not, then that's not good for the economy. Oil inventory levels, if they're down, that means people are driving, they're spending money, they're helping the economy. If they're not driving, that means they're not spending money, they're not helping the economy. Or other things, we need these numbers up, and so with the CB consumer confidence, the previous report for the month of December was at 115.8. Their forecasts the confidence level to be lower. Remember, the lower the number, the more bearish that it is. So if it's under this, then it's definitely going to provide a lot of bearish characteristics for Tuesday morning. And even this, I think it could even provide bearish characteristics. If it can meet or beat the previous, I think we'll see bullish characteristics, but I would say there's a 20% chance of that happening. 80% chance we should see some pretty good bearish activity Tuesday morning, because I don't think it's going to be this confident. And so Tuesday can be very bearish throughout the majority of the day, but we could see, just depends on what happens Monday before close. If Tuesday is up, Tuesday morning, because when we're looking at the times of these, in Eastern time, the stock market opens at 9:30 in the morning, and so this report will be released 30 minutes after the stock market opens. And so this will just really affect, if the pre-market is bearish, it'll just make it more bearish. If the pre-market opens in the green with bullish, this report comes out, most likely that'll ruin it, and it will make a bullish morning turn into a very bearish day. So I'm pretty sure that Tuesday is going to be very bearish. And most likely, the pro investors are looking at this just as we are. And if they're doing it, you got to do it just as well, because they're already going to know Tuesday is going to be bearish. So they'll probably start buying puts on Monday before close, because it just seems like it's going to, because the forecast number is going to be less, and they could be just trying to, it could be in the 90s, but during this time, this report is almost released instantly. Now, this information, you're getting it the same time the news companies are getting it, and everybody else. Now, it takes time for the news companies to get this and to process an article and to send out maybe a news alert. By that time, it may have already been too late. So it's very important that you try to get this information as soon as it happens. And so right when that time comes out, you can easily go to your app, pull this up, or on the website, and boom, it'll show you the actual report. So that way how the market will most likely respond to it. Because it doesn't quite respond to it instantly. It could take 5 minutes, it could take 10 minutes, it could take 15 minutes, it could take 30 minutes, or maybe even an hour for the news companies to process this information, make an article, send it out, and for the investors out there around the world to react to it. They could do a sell-off, they could do some massive buying event where they could just buy, and so but at least you'll know before everybody else will. And so that's why it's very important to be aware of what's going on, and by utilizing this information. So Wednesday, we have on Wednesday morning, 30 minutes after the stock market opens, we have our new home sales report for the month of December. And so, and again, if you're not sure what they are, you can click on it, but it's basically, these are completely brand new homes where existing homes would be like your used homes that have already been built, whether they were built 5 years ago, 50 years ago, 100 years ago. New home sales require, materials, wood, lumber, all that stuff to build that, whatnot. But this is again for the month of December. The previous month, for the month of November, was up at 744,000. But December, though, it's forecast to be at 760,000. Which is kind of strange, during the winter and when it's snowing, we had I think, what would we have, hurricanes and snowstorms and whatnot around the country. Why in the world are they setting the bar so high? It's like they're setting it up for failure. And plus, when we've seen some other previous reports, we saw a slowdown in home buying. And typically, I don't know if you guys are into real estate or any of that, so you guys know that, and if you don't know, that people tend to usually buy houses before the holidays because they want to get in their house before Thanksgiving or before Christmas. That way they can get things all set up. That way they can set it up for the holidays. And so once we get into the December, we see a slowdown in home sales. And so why in the world did they set the bar so high when the home sales start to fall? So just be aware that this, so if the actual report comes back and it's less than the forecast, but it's between the previous, that'll still provide some bearish characteristics. If it's over the forecast, that could easily turn into, which I believe Wednesday morning is going to be bearish because of what we're just talking about. So Wednesday morning, I think it's going to be bearish, and then, but if it does seem to beat that, then we can easily turn a bearish morning into a bullish morning. So we'll have to figure out what this is going to do. But like I said, I feel that the bar is set way too high on this, and because I think they're doing it intentionally to pour more fuel on the fire. They're trying to push the market down by manipulating these numbers and stuff. And so, but the only way to really know this stuff is to look at this stuff regularly every day. I've been looking at this stuff for several years, so it just by natural, because of the history and stuff and how all this stuff works, because there's a yearly algorithm, and so you just over time you just know, but you have to look at it daily. And then it'll just click for you one day. So, but so we'll just have to really watch this one, because something seems very, very suspicious. So the next report, 30 minutes after that, so 1 hour after the stock market opens, we have our crude oil inventory reports that'll then be reported. Now, they were up a lot the week before. We need these report levels to be in the negatives. This was in the positive. And so, but a lot of people were traveling during the holidays and stuff. They're starting to slow down and whatnot. So that's normal. But the same effect too. Even though if people aren't driving as much, the cost of, or the value of the barrel of oils will then begin to start to fall, and the gas prices will start to fall, which would be nice. But like I said, if this invasion happens, then the values will just naturally go up. But there's no forecast, and so because they're working on it, we'll have to come back to that either later tonight or tomorrow morning to see what they updated it to. Now, most likely, this was a big surge upwards, which is very bearish. Most likely, it always bounces. It bounces off a surge or a plunge. And so most likely, we'll see the oil inventories level come down, which will be bullish. And so we could... so it seems like, so Wednesday we could see some mixed signals. We'll see some bad news, good news, and then bad news. And so we're going to see some pretty interesting mixed signals Wednesday, but we're going to see a lot of great volatility, which will be a key ingredient to our day trading strategies. So the FOMC statements and interest rate decisions and stuff, those are going to definitely provide some bearish characteristics for the majority of the stock market. But again, like I've mentioned before, we're entering a bank season as well as energy season, where but primarily bank season, where interest rates are, as they're going to start increasing them. I think they'll start going up next March. Banks will become more profitable, so the values of bank stocks are going to start going up for for several years. So looking for long-term stuff, definitely, like I said, banks are kind of one of the main things a lot of long-term investors are looking at right now, like Bank of America or Wells Fargo or JP Morgan, and and on and on. And so but just know that this I think is about 1 hour before the stock market closes is where these little government meetings are going to take place. So there's going to be a lot of volatility Wednesday right before the stock market closes, and it will most likely be a plunge. It's going to go boop right down there during that first hour, and it's not going to look good. Where normally, last year when we saw a lot of these FOMC statements and interest rate, meetings and stuff, it was just all talk. It was just talk, and sometimes you see a lot of volatility from that, but then you'd see a recovery right before close. Well, it's not talk anymore. They're talking and they're doing, and so the doing part is what is spooking the investors and the and traders, and it's causing the sell-offs. And so we just got to really watch out for this. But like I said, so far this week looks very, very bearish, just from what we're seeing so far. And then Thursday we see the core durable goods orders for the month over month of December. Now this report, since this is 8:30 in the morning Eastern time, this report will be out 1 hour before the stock market opens. So this is during pre-market. I wish some of the other ones came out during pre-market throughout the week, but it just really helps provide more volatility. But Thursday morning looks like we're going to see a lot of volatility 1 hour before the stock market opens, because there's 3 economic reports. Now, when we see yearly economic reports, those were going to hold the most volatility because they're more rare. If we see a quarterly report, those are even more rare, because the yearly report, you only get those once a year. These you get 4 times a year. So this will provide a lot of volatility. Now, then you have your monthly reports, which do provide a good amount of volatility. But then you have your weekly reports, which provide a decent amount of volatility. But like I said, the yearly and quarterly reports are going to hold the most effectiveness of the stock market. But then we have 3 of them all at the same time, so you get kind of like a trifecta going on for Thursday morning during pre-market. The core durable goods orders, and again, if you're not sure what those are, feel free to click on it. You can kind of get a little information letting you know that the core durable goods orders measures the change in the total value of the new orders for long-lasting manufactured goods, excluding transportation items. Because aircraft orders are very volatile, the core number gives a better gauge of ordering trends. A higher reading indicates an increased manufacturing activity. So a higher than expected reading should be taken as a positive or bullish for the US dollar or the stock market, while a lower than expected reading should be taken as a negative or bearish for the US dollar or the stock market. And so obviously it's forecast to be down, which is not good. The previous was a little better, for November, but there's just a shortage. There's a shortage of materials. There's a shortage on all kinds of stuff, and so it's really affected a lot of things. It affected the retail sales for December because of these core durable goods orders. And so last week we had the retail economic report, and it was terrible. And so it'll be followed by this report. And so the JDP or GDP, which is your gross domestic product, measures the annualized change in the inflation-adjusted value of all goods and services produced by the economy. It is the broadest measure of the economic activity and the primary indicator of the economy's health. And so, but it's interesting. They definitely have a high percentage on it. Almost 5.5%, where the previous quarter was up 2.3%. So you obviously think that the fourth quarter is up twice that, or more than twice that. And so we'll have to see what happens, because I think it'll be between this, and if it comes back even below that one, it'll definitely provide some bullish characteristics. But as long as it's up over the previous support, we're good. We should be fine. So this one might, if it's in between, this report may not affect the stock market as much, but we'll have to see what it does. Investors are going to wait and see, and because they'll determine whether the rest of the day is going to be bullish or bearish, mostly from this information. But we could see mixed signals. One of them could be bullish, the other one could be bearish. So we'll have to see if we will have mixed signals, and if the stock market kind of picks one over the other for the majority of the day. And so the unemployment report, which was kind of trickling up a little bit there for the last couple weeks, almost back to 300,000, when it was down quite a bit. But since we've seen kind of a surge in unemployment lately, I would anticipate that we should see it to trickle down a little bit. Especially, we haven't had very many storms and things. I think things are kind of getting a little better with certain things, and so I think people are starting to get back to work. So I think we'll see the unemployment report come down a little bit, and hopefully we'll see it around the forecast amount. But as long as it's less than last week, we should be fine. If it's less than the forecast, we're even better. So that should provide, I would think, some good bullish characteristics. We'll kind of have to see what the mix looks like. Now, after the stock market opens, looks like we got 30 minutes after the stock market opens, we have the pending home sales for the month over month of December. So it looks like November was down negative 2.2%, but it's anticipated that it'll be up 0.3% from that. So I'd say that's realistic. So we'll have to kind of see what that looks like, because at the same time, there's a lot of people that are trying to buy cars and homes before the government starts to increase interest rates. And so there could be a lot of pending home sales, and so that could help provide some bullish characteristics for the morning. But come close on on Thursday, we'll just have to see what happens, because this could have a big impact with Thursday. But Friday, there's nothing scheduled for Friday. There's a lot of uncertainty going on, and with the weekend approaching, the weekend we'll have the same kind of effect as we did last Friday and Thursday of what if Russia invades Ukraine throughout the weekend. So they're all going to pull out. We're going to see another sell-off again, and so we're going to see, unless they come up with some kind of resolution to work things out, that's the only way we're going to see the stock market change its trending direction. And so, but out of all the politicians and analysts, they're even though they're trying to negotiate and whatnot, they all say that no progress has been made. And so there's a lot of theories with all this. Russia, Putin wants to build like these gas pipelines and oil pipelines through Ukraine and through certain European countries, because it'll benefit them and it'll benefit other European countries. However, Ukraine doesn't want pipelines through their country, especially from Russia, and so they're just telling them off. And so Russia needs that territory. They need that territory so they can run these pipelines through that country, so that way they can get to the other side. That way they can run oil and gas or whatever, through those, and it'll benefit not only Russia, but it'll benefit all these other countries that these pipelines are through. So it makes you wonder, are they all in on it? And so it just seems like they're just trying to, when they took over Crimea, it just seems like that they were trying to eliminate as much casualties as possible, making a big, commotion about it. And it just seems like they're kind of getting ready to do the exact same thing with Ukraine. So it's just something that we got to pay very close attention to. And so there is another area. Let's go back to so on our website, but also it's on the investing.com website. Let me go back, see if it's still on there. No, and sometimes once it's on here, sometimes it's hard to find them back on here. So I try to post the important stuff, like the top 5 very important things to watch for this week on investing.com. So if I click on that, it'll take us back there. And once we do our due diligence for, to planning ahead, we want to check this page out. Investing.com posts this every Sunday morning. We need to read it just to make sure we didn't forget anything. So investing.com, okay, so it says that it's set to be a major week for the markets between the Federal Reserve meeting and an avalanche of big name earnings. The federal chair, Jerome Powell, is expected to signal that the central bank is on course to deliver its first rate hike since 2018 in March. In a bid to tackle soaring inflation, tech giants Microsoft, Apple, and Tesla are due to report, with investors looking to earnings results for reassurance after last week's sell-off. But market volatility looks set to continue for now. There's also data on the United States fourth quarter, the GDP, while economic data out of the United Kingdom and the Eurozone will show an impact of the Omicron variant. Here's what you need to know to start your week. So the first one is the Fed to signal the March rate hike. Investors, let me highlight this stuff here. So investors are looking to the Fed for more clarity on the investors like you and I, we're looking to the Fed for more clarity on the future path of interest rates after the data last week showed that the United States inflation rising to a near 40-year highs. Jerome Powell is expected to indicate that the Fed will wind up its bond purchasing stimulus program on schedule at its March meeting and raise interest rates by a quarter point from current levels close to zero at the same meeting. With markets already pricing in roughly 4 rate hikes this year, really? With markets already pricing in roughly 4 rate hikes. I thought they said 3, now the 4? My gosh. Rate hikes this year, investors will also be focusing on what the Fed says about its almost $9 trillion balance sheet. Markets currently expect the Fed to start trimming the balance sheet later in the year as a way to tighten monetary policy. The minutes of the Fed December meeting indicated that the officials held lengthy discussions about reducing bond holdings. Any indications that the balance sheet could be shrunk faster than in the past could extend the sell-off in treasuries and tech shares. Not good, very bearish. A lot of volatility is what that's saying. And we knew that as we're talking about looking into the week and everything. So number 2, earnings deluge. Giant or tech giants like Microsoft, Apple, and Tesla are among the big names companies due to report in what will be a hectic week for earning results. With investors looking to separate pandemic success stories from fundamentally strong companies, the Netflix tumbled over 20% on Friday, weighing on the S&P 500 and NASDAQ after it forecast new subscriber growth in the first quarter would be less than half of analyst predictions. That's crazy. I mean, how is that possible? Especially with the new that show from last quarter, the Squid Games. They got a lot of new subscribers from South Korea and in many parts of Asia, but at the same time, Netflix keeps increasing their rates. They send everybody, a lot of Americans, starting next year, your bill's going up $1. Well, Americans are starting to say, well, F you, Netflix. I'm going to stick with Apple or Amazon Prime or whatever. People are starting to kind of react a little differently to these price changes and exploring different apps like Peacock or Paramount Plus. Watching Yellowstone or 1883, great show by the way. But for a lot less money, and so even though Netflix may have gained subscribers, they're losing some pretty valuable customers at the same time. And so it's very unfortunate, but I believe that Netflix has been highly manipulated and their stock had plunged way too much. It was anticipated that there was going to be a 10% movement, either up or down, but it was far more than that. So a lot of investors, especially very wealthy millionaires and billionaires, they're going to invest a lot into this highly manipulated stock because Netflix is going to easily recover. So, but we could see more, like it says, more of a downtrend with tech until further notice. And so Microsoft, which reports on Tuesday, is expected to report quarterly revenue of more than $50 billion for the first time, according to the data compiled by FactSet. So Tesla and Apple, reporting Wednesday and Thursday, respectively, are expected to post record profits, according to FactCheck. Who the heck is FactCheck or FactSet anyways? So, but obviously we got some manipulation going on there. But we know the numbers, we know the percentages, we know our risk levels. Beyond tech, there are a host of other big companies reporting, including 3M, General Electric, IBM, Intel, Caterpillar, American Express, Boeing, MasterCard, Visa, McDonald's, Johnson & Johnson, Colgate, and many more. So a lot of earnings and volatility coming up. So next one, we have the market turbulence. Highlight that. Markets look set to remain turbulent in the coming week, with investors focused on the Fed and earnings, which we already knew that, as we were able to look at the scheduled week in the continuation of the tech sell-off that has pushed the NASDAQ into correction territory, which we talked about earlier. Wall Street's main indexes closed sharply lower on Friday. The S&P 500 and the tech-heavy NASDAQ posted their largest weekly percentage declines since the start of the pandemic in March of 2020. Tech companies largely benefited during the pandemic and saw their shares soar over the last 2 years, but tech and growth stocks have been hard to hit since the start of 2022 by a rapid rise in treasury yields on the back of expectations that the Fed will hike interest rates aggressively to combat high inflation. Now, keep in mind, they originally wanted to do 2 rate hikes per year, then they tried to negotiate 3, and now we're seeing 4. Higher rates can hurt tech companies. They definitely will hurt tech companies with high valuations based on the prospect of future profits. They won't be profiting as much anymore. inflation. These companies profiting a lot from the inflation, and so now the next several earnings reports are going to be a little trickier. Number 4, United States economic data on Thursday. The United States is to release advanced data on the fourth quarter gross domestic product, with the economists expecting annualized growth of 5.2%, expecting have been pared back in recent weeks as rising coronavirus cases driving by the Omicron variant hit economic activity. Which I think investors really are bored of this coronavirus, and I don't think they're really focusing on cases as much anymore. And you look at cases now of the flu virus, it's up, sky high, and so it's just not affecting investors anymore. They're bored of it, just like we all are. They need to get rid of this. We need to go back to normal with this common flu that they keep coming up with a name. So, but the economy, or the economic calendar, also features December data on personal income and spending. Economists expect personal spending to fall sharply given the steep decline already seen in retail sales last month. There is also the weekly report on initial jobless claims, which is your unemployment report, which jumped to a 3-month high last week. So that's where I was saying we should see it kind of come down. So that should provide some bullish characteristics. Some of the economists are worried that the increase in jobless claims or unemployment, along with the sharp drop in December retail sales, could be an indication that the economy is losing momentum. But this is unlikely to stop the Fed from hiking rates in March. Number 5, which won't have as big of an impact in the United States stock market as much as it will with these other ones, but it still will, and it's still good to know what's going on with our allies. And so the Eurozone's largest economy, Germany, is to release the fourth quarter GDP data on Friday, along with France and Spain. The figures will show the impact of the Omicron variant on the economic recovery ahead of the GDP data for the bloc the following week. The Eurozone is to release the PMI figures on Monday, which will show how the economic activity fared this month. The United Kingdom is also to release the PMI data on Monday, while service sector activity slowed sharply in December amid the Omicron surge. Other data since then has indicated that the economic activity has begun to rebound. The data is expected to show a slight uptick from December, and for now, the Bank of England still appears to be on track for another rate hike in February. So for the majority of things, it looks very bearish for the most part. But it looks like we found most of the stuff as we did our due diligence. We found maybe a couple things that we weren't aware of, like they did the 4 rate hikes per year for the next couple years rather than 3. And so now we have a great idea of what to do and what to look ahead, how this week is going to look like. I don't think I have really anything else. Any of you guys have any questions or comments? I'll look down our little chat menu here, see if you guys have any questions or comments. Feel free to unmute if you guys want to share. It looks like your hand is up as well. If you have a question, let me read your comments here in your in the chat room here. But I'll figure out where I'm at here. Patterns. Show us. Can you show us how to choose strike and straddle? Okay, so we did that. When to enter and exit a straddle. Yeah, we went over that. When to enter, when to exit. Basically, straddling right, pretty much right before close for the most part. You could straddle throughout the day using, like, if you don't have
you don't have a day trade and you're going to maybe try to straddle, you can try to buy your calls and puts based on your buying and selling signals throughout your moving averages. That way you can try to profit both from your calls and your puts at the same time. But like I said, you don't want to hold too long. You get in one day, sell the next day, and then you can change your strike prices according to what's going on with the stock price. It's based on chart. Calls on Microsoft. Joe said it's looking like it. With all the news and activity, we'll have to kind of see what people are doing. And again, sometimes it's hard to look at people's calls and puts looking at the weekend, because of there's just so much of this stuff that could be expired. But by looking at calls and puts here, we do see a pretty valuable call here, this 305. So most likely this is not expired. So let's click on it, 305. Looks like it expires this Friday, January 28th. So 305 should hold the highest volume activity. And look at that, the open interest is only 1,600, hardly anything. And now all of a sudden we see over 16,000 in volume. That's like pure buying activity, because the volume exceeds way over the open interest. So people are buying a lot of the $305 call strike price. Where is it at now? It is at $296, but the 305 seems to be the most, holds the majority of it. And then we have a 310, which is kind of the same, where we're seeing a lot of volume activity and very little open interest. But the biggest gap is the 305. So the 305 call may be the one to focus on the most for Microsoft. And then we can also look at the puts and kind of determine which ones. Let's look at 300, see if that one's still, okay, so that one's expired. That one expired last January. So we need to see, most likely that one's expired too, because the value isn't very high. Yeah, January 21st, so that's expired. So then we go over to the 310, also expired. So we're finding, I would say, we found a call a lot easier than we did puts, because a lot of these puts are probably expired. Oh, so this one, January 28th, so 320 put strike price. This is way in the money. Let's see if we can find something that's not in the money. So we have a 290. Let's see if that one's still active. Yeah, that one's active. So January 28th is the 290. We do see an open interest of 1,700, but the volume is only around 8,700 versus the 305 at 16,000, almost 17,000 in volume. So really you got two, out of three versus the other one. So you got 2/3 of people that are betting Microsoft's going to go up, and 1/3 betting the stock's going to go down. Going into Monday, though, of course. So this could all look different as we go into the week right before earnings. So we'll really have to pay attention to this. And again, it's just the NASDAQ. If you go to Google, type in NASDAQ, and then the ticker name, most active options, and then it should take you to this page. If it doesn't, it'll take you to this the options chain. Just scroll down to the bottom. You'll see also option chain most active, and the most active is the key point. But once you get to the URL, you just got to change that little ticker in the URL address to a different ticker, and it'll always take you to the most active individual calls and puts for that stock option. Next question: when to enter and exit straddle in trades? So we already talked about that one. Very informative, thank you. You're welcome, Colleen. I'm available 24/7. Feel free to message me anytime through the Facebook Messenger. My goal is your success. The more you learn, the more you're going to earn, and the more this is going to be a life-changing thing for you guys where you'll be able to make, $10,000 a month or $100,000 a month, $100,000 a year just from doing this from home. You'll be able to travel, you'll be able to pay cash for a vehicle or to help your neighbor. You'll never look at prices again. You'll be able to shop online a lot more and just help people out. You'll live a healthier life because you'll be able to buy more quality foods and items and things. This is huge. So I'm really honored to be a part of your guys' experience. And so next question, what do you think of Netflix calls for Monday? So we'll really have to watch to see, because for the most part you would think so, but we'll have to see what the market's doing and Netflix is doing and the most active calls and puts for Netflix, because it most of the time when a stock does that little algorithm, it's going to be flat for a couple days, and so we'll just have to see what it does. But because I feel that Netflix has been highly manipulated, it could start recovering pretty quickly, more than average. And so we'll have to see what Monday looks like. But like I said, the majority of the week does not look good for tech stocks. It looks very, very bearish. We can see with a lot of the information that we've seen. So tomorrow morning let's do another live Zoom meeting 1 hour before the stock market opens, and let's do another 1 hour Zoom meeting during power hour. And that way, as we're able to, as I was able to kind of explain what to look for during pre-market, what to look for during power hour, we can kind of do a live little thing. So hopefully you guys can tune in. I'll be able to share the link. It'll be the same link that you guys use for this. In the meantime, do you guys have any questions or comments before we go? Sorry, this took so long. This was supposed to be shorter, but it became longer.
Mr. Carlos, I have a question.
Yeah.
Is it possible, people like me still have a very hard time to understand those charts, actually explain all the meaning and also the analysis of all the stocks. So is that possible that you have one meeting just only for analysis, technical of the chart, so we can understand that how actually we can choose which stock we should buy, when to buy, and when we should exit. So that's all. So, thank you.
Yeah, that's a great question. And when we, every Sunday morning we always have these meetings, and that's definitely something we can go over. But also as we try to do things live too, like before, during pre-market and during power hour, which is the last hour of the day before the stock market closes, we can kind of also learn on the fly, because like I said, confidence. Sometimes as we work together as a team, sometimes that's where we're the most effective, rather than being individual. It's nice to have a couple buddies and friends, or people that are, because a lot of times most investors, they don't know anybody else that's into this stuff. We're all on our own. But however, we can form this phenomenal team of what I call stock market ninjas, so that way we can help each other to learn. So that way, as you start to learn, and you can help the next person, and that we just all work together. So but yeah, we'll definitely do that. And like I said, just be aware, we'll go live twice more tomorrow, and that way we can kind of continue our education and always be learning. Any other questions or comments before we go? Everything makes sense? All right, everything looks like it makes sense. So Again, this is a recorded video. I will upload this to YouTube and everything, share it with you guys. It'll probably take several hours, but thank you guys very much. If you guys ever have any questions, feel free, don't hesitate to let me know. You guys stay safe, make good choices. Let's make a lot of money this bearish week, and yeah, let's have some fun too while we're at it. You guys take care.
Thank you.
Thanks, Carlos.
Thank you.